Recording. Hello, Safe.
Hello,
Sean
Tom.
Thompson, nice to see you again.
Likewise.
I'm glad to finally see your premises and your office.
Thank you very much for taking the time, for coming here to visit us after like our first meeting with our event, and I'm really looking forward to that. So, how are you finding the weather here in Montreal?
I find it quite difficult, to be honest, but that's fine.
It is. I had a trip over the weekend that got cancelled just because of the crazy freezing rain. I changed my tires here. That's one thing we do. We change the tires when it's spring, and then you can't drive anymore because of the freezing rain. But thank you very much. Thank you for taking the time. Your VC, as you know, is one of the most respected VC firms like globally. And I heard it's been a good year for VCs. You had a lot of deals and you closed a lot of deals. I heard that VCs spent about $84 billion this year.
Well, you heard right. We're quite busy as always. That's the name of the game, as you know. But dealing in volume is not the prime focus of our company. Is to deal in quality. We're looking for quality companies. So the size doesn't matter ultimately.
Yeah, of course, but I mean, your VC out of all other VCs is one of the VCs that are known to be there for their company portfolio, right? Portfolio companies, right? You're there, you support your VCs, expertise, funding, and I mean, like, it's really good to be coming from such a VC.
It's true. Well, I mean, when we're dealing with high growth companies, it's important that we give them some structure, we give them some coaching and all the necessary resources that they don't necessarily have early on. So I think it's important that we support them right with the rights ecosystem, professional abilities, network, and whatnot. And it's true, we are very invested with our companies, and that's why we came to see you.
Great.
We think you guys have a lot of potential, and
I mean, it's a cool idea. Right? When you think of it, it's really cool. Right?
Yeah, for sure. I mean, I don't know, maybe one day you could take me up there. I'd love to see what it looks like
sure.
from outer space.
Sure, that's why we need these 6 vehicles.
Yeah, that's cool.
Great, so I mean, we're here to discuss the VC equity, right? And things that are included with VC equities, such as this talk and board members and things like that. So I mean, we have a lot to discuss, and I understand that your schedule is kind of like hectic for the day.
It's fine. I'm here for you.
That's great. That's good to know, because I mean, we have a lot of points to go through, as you would understand for this. What's the lingo you use in VCs? Is it a fact sheet or sheet terms or term sheets?
The term sheet.
The term sheet, right? So we need to go through these points. So I mean, up to you, but I would feel like we should start with the VC equity, right? That's the most pressing point to discuss.
All right. If you want to, that's fine. We can talk about equity right now.
Sure.
I have certain points in mind, but if you would like to start off, I'm willing to listen.
Great. So at this point, we're looking for $100 million in investment, as you would know. Again, to have these 6 new vehicles where we have been testing. We tested a lot of orbital, kind of going around the orbits for space traveling and things like that. We believe that our numbers are much better than the airline industry in just 100 years, maybe even 90 years, exactly 100 years from now. It's safer to go in our space travel. We have our testing in check, and I think we're ready. And for that, we need a boost of 2 main things.
Yeah.
Right? We need expertise. We don't have expertise in all the fields of how do we market that and all the things around like SG&A, marketing, advertising, and things like that, as well as the funding, of course, to support these vehicles.
Yeah.
So we're looking for 100 million at that point,
Yeah.
and our current valuation is around the 350 million.
I've got a lot of questions actually. You
Sure.
went through a lot of stuff,
Yeah,
and if you don't mind, I'd like to
of course.
ask
Of
you a
course.
couple of things. We give it to understand you guys have done approximately or maybe exactly 15 test runs with your vehicle,
Okay.
and all of these test runs were successful up to date.
Yeah.
And I'm a little bit uncomfortable when you compare it with the airline industry because it is. It's not the same thing exactly, and 15 test runs when you compare with the entire airline industry, it's a very difficult comparison to be made.
Sure, I'm not comparing today. So I'm comparing today. Like, yes, of course, I understand your concern. Like 15 is not a number that is a large number for testing. But what I was trying to say is putting this 15 tours of space to date in perspective. It's much safer than the airline industry 100 years ago when the airline industry started like commercialization and things like that. So if we're comparing when the airline industry started in 1920, by and large, we are much safer than that. Yeah.
Okay. I don't know if you want to keep talking about safety because we started talking about equity, but now that we're on the topic of safety, do you foresee any significant hurdles in terms of making space flight mass marketable in terms of safety?
Yeah.
Are there any challenges that you're trying to overcome right now? Are there any security issues that I should know before I get involved with your venture?
So that's a topic that I take again very seriously. I mean, like I tried to emphasize on that at the beginning, but I'm re-emphasizing on that. It's a topic that is not that if I know something, it's not going to be hidden, right? We did the 15 tours. The 15 were successful. We did not encounter anything that kind of gives us a feeling that this is not a safe endeavor to be at. Definitely, we are above the measure of 90-20 for the commercial airlines. We are safer than that. And I believe that like my design, because at the end of the day, this is my idea.
Yeah.
That my design will immediately make this whole space tourism industry significantly safer.
Significantly safer than
the early years.
Than the early years. Aerial, non-orbital flights.
It's a new field, right? Like and that's why I'm not asking for a fleet of 100 flights. I want to start with 6, and of course there will be continuous testing for that. And if there is like a 6 sigma of 1% that I know it's not safe, I'm not gonna be an advocate for that, right?
Okay.
Because I go on these trips as well.
I hope so.
Yeah.
The reason why I'm telling you this, and I feel like I should tell you where I'm coming from with this, is that at this early stage in the company, and with such a big investment on our behalf, any mishap, any problem, any security issues is a huge setback to this investment if anything happens, and that represents any problems with future flights is a killer for this industry. So we have to be entirely 100% sure that
that goes without saying.
Yeah.
That goes without saying. And I'm even ready to give you like a guarantees or an insurance for that when we discuss our deals. There are a lot of ways to insure. Again, the 100 million, most of it is not going to go into how do you say that? Most of it is not going to go into like buying mansions for myself, right? Most of it is going to go to things that are going to be an assets for the company. And I'm very open to have to insure you and insure your venture capital with any sort of a deal that you have the right to claim first, or any of even right to refusal and things like that. This is my endeavor, right? And I look for people who share this like share this passion about making this space travel happen.
Mm-hmm.
But I do understand that at the end of the day, I'm the one who's working on that,
Yeah.
and I need to guarantee and I need to ensure my stakeholders and my partners that I will not slack at that.
Okay.
Yeah.
All right, that's good to know. There was another topic that you touched upon.
Sure.
With regards to the support that we're going to give you.
Of course.
And this, and you mentioned marketing, sales and general administration, overhead essentially,
Yeah.
or proper management to sum it up.
Yeah.
And I think as concerned as you were about safety, I'm as concerned as you to give you the proper tools to succeed. And if this deal is to fall through, we would be fully invested in giving you the proper resources that you need to manage your business. And that could be overhead, it could be professional access to professional networks, if needs be communication, marketing, all these things.
That's great to hear.
But let's move on, and we can bring this back a little bit later. So you wanted to talk about equity, and more specifically equity percentage or of the stakes.
Of course,
And
yeah.
you valued. I heard you before. You valued the
Yeah.
company at 350 million.
So
If I heard you right.
the number is correct, of course.
Yeah.
Yes.
And
I did not value the company
Yeah.
myself. The company is valued through like different financial basically advisors and people who went through our all our like forecasted cash flows, our R&D, basically like the value of the R&D, the amount of cash that can be generated if
But
this scales.
could you be able to walk me through it a little bit more, because it's my predictions are a little bit different, but I'd like to see where you're coming from with that.
Sure. So I do
If
not
it-
have the valuation as an Excel sheet in front of me, but I can go back to my
Here notes.
basically to my to my financial advisors and people who did these valuations. But yeah.
Oh, so you essentially they're based on your financial forecasting and your R&D expenditures.
Yes.
The number was 350.
Yeah.
That's significant discrepancy
Well,
between my forecast. That's all. A similar procedure
sure.
gave me a valuation of 150 million after investments, after equity, after this equity round. So a post round valuation of 150 million.
Oh.
Yeah. So it's different, but let's talk about it. Let's talk about it. Let's smooth it over, because there's a big difference.
So I value based on the cash flows that I have, and as you would know, there are multiple ways to do the valuations,
Mhm.
right? And given that we're not out there yet, we're not selling something per se, then we used a lot of comparables to companies who were at these phases and who were passing through these phases and did these valuations. But again, we based on some numbers that we have internally. I'm very interested to know, how were you able to get to this number, given that you do not have our like financial sheets and things like that?
Well, I guess if you were to share your financials, but there's not that much information to get from it at this early stage in the company. As you say, you're pre-sale
Yeah.
at this stage, so in terms of cash flows, it's highly unpredictable, and doing an evaluation based on the current numbers, and I'm all for doing a evaluation with a comparable in these things, and and that's very good that you did that.
Mhm.
I think with current numbers, it's very, like you say, it's highly uncertain.
Mhm.
So I think if you mentioned comparables, and that's information that I didn't have, and the evaluation you did, how many competitors do you have at this stage? Do you know? Would you know, or let's say to how many different people did you compare?
So, to my knowledge, my design is unique.
Mhm.
So there is no an apple-to-apple comparison in terms of another company that is offering the same kind of like activity or the same product or the same service. But also to my knowledge that a lot of times startups have kind of different and sometimes same growth strategies, and comparing these different industries, and knowing my design kind of inside out, I believe that the comparables, if I benchmark it to 4 different industries, because again, this is a very unique industry.
Four different. This is what your data has come up. 4 different industry comparables.
Exactly, different at kind of the same growth phase that we have at that point. But then again, from my estimates, I was not able to see a company that I can compare an apple to apple, and because again, I believe my design is unique, and I believe that what we're offering is not like you don't have a lot of companies that are at that point where we're at in terms of progress, that we're very soon to make this public.
Okay. Well, I think you've done a thorough evaluation, and I appreciate that, but I think maybe you can understand my concern that making a comparison with technology that's so unique, as you say, it makes my trust in the number just falter a little bit, and I find it difficult to base an equity, our equity stake on that number because of exactly that, the uncertainty with regards to the uniqueness of your technology. It's going to make me difficult to latch on to that 350 million. That's what I'm saying. And I'm saying I don't believe you.
No, I agree. I agree. Again, like when I'm evaluating my firm, obviously I will use my knowledge that is not accessible to anyone else who's evaluating it, because right, I'm the one who has the data and everything. And at the same point, I might be having different scenarios that, as you know, there's always like kind of best case scenario, worst case scenario, and like moderate kind of scenario, right? My concern though, having said that even my worst case scenario was not even close to 150. So that's why I'm really worried about how we're viewing this endeavor. And I mean, like, if my worst case scenario is around how much exactly above that?
Yeah, take your time if you want to look at your data. I'll take some time to look at my numbers just to make sure.
Exactly, I have the numbers. My worst case kind of estimate is kind of around like 140 million above the number you gave.
So 290.
Yeah.
Okay, that will be a contentious topic of discussion. All right. Well, let's. You know what? I think we've covered that subject a lot, and we can come back to it after we've talked about other topics. But I think we've covered it pretty well, and I hear you. I want you to know that I hear you, and about what you're putting forward, the number you're putting forward. But I'll definitely need to think about it a lot more.
So on that note, I was saying that I'm very open to offering you in kind of like an insurance, and that's why when we offer equity to your firm, I'm very prepared to offer it in terms of convertible preferred. Okay. Yeah.
Okay, that's good to hear.
Right. So I think the way convertible preferred will play is something that it's kind of insurance for you. You have the first right to claim, right? And you know that we have a lot of assets. These things are not going to go anywhere.
How much do you have in terms of assets in total?
No, I mean like when we have these 6, right? That these $100 million would be used to buy 6 different vehicles. These 6 vehicles will not go anywhere, and you can at any point. Well, I mean,
it's difficult to sell.
I see what you're saying. Yeah. I completely see what you're saying, and there's also a risk of something happening to one of them, right? Not all of them at the same point, but one of them, something happening to them. I agree, but still, again, a salvage value for that would be, at the very least, close to recuperating what you invested in, right? And I'm giving you the first right, and I don't mind if I lose everything at that point.
It's for me, it's not much of a concession, because venture capitalists investing is standard to have convertible stock. It's an industry normal. It's a standard. Common share is especially for a firm like us, it is not it's not an option in terms of when we invest. So convertible bonds is standard, and I appreciate that you recognize that standard, but it's a normal, it's a given.
Yeah, but what I'm saying here is that this adds kind of a layer of insurance, right? And that's why VCs do that by and large, right?
Yeah, but it's standard practice, and that's what I'm saying.
And another thing I feel that would be, again, sort of kind of like to make you know that we're in this together, is the number of board members that you are interested in.
Mm-hmm.
Again, we're 3 at that point. So, I mean, I'm looking for 1
Okay.
at that point. Just so that we have, like, again, the...
Yourself would be on the board. You yourself.
I am on the board,
Yeah.
and there are 2 other people on the
But
board.
you would be looking to remain on the board, and then we would.
Of course, and I would be interested in 1 member to have my board jump from 3 to 4, and this 1 member is from your VC.
Oh, I see.
Yeah.
Why is this so important to you?
Of having a VC board member?
A single VC board member,
Opposed
and
to
remaining the 3 board members from.
other
Earth
investors.
Escape. They're your
So
current investors.
They are my current investors. We did the seed round together 4 years
But
ago.
you do realize that the $100 million investment largely surpasses what your current investors have given you so far, and which is not, it's just good, but it would be a board that's not very representative of
I would say
the equity percentage.
I would say it depends on the valuation. That's why I felt the valuation is kind of like really important, because it will depend by and large on the valuation. If we go by the number that I was proposing at the beginning at 350, right, then it's actually comparable. Then one person, right, presents this kind of percentage.
You 3/4 of the board would be Earth Escape, and 1/4 of the board would be from our firm, but yet 1/3 of the investment, if the valuation is at 350, and I'm not saying that at all, I think it's unreasonable, given those numbers. If we're talking proportionally speaking.
If we're talking about 1/3, and then
because the $350 million is a post valuation.
Yes.
So that means in that $350 million, you include the 100 million that
Of course.
and therefore 100 million accounts for roughly 1/3
Yeah.
of that, but yet we would have 1/4 representation on the board. I'm just saying there's an inconsistency there, that's all.
I agree, but it's just a 5% inconsistency. If we add another person, then you kind of have 40% for 30%.
Yeah.
But it's something I'm open to.
Okay.
Right?
Just, can you give me a second here?
Sure.
I'd like to write a few things down.
I know we have to broadcast that later, and we have like kind of a limit of our broadcast bandwidth, so whenever we need to restart it.
Oh, we still have 6 minutes on this.
Okay, great.
It'll ring.
Okay, great.
Give me a second here. Okay. Sorry, it won't take much longer.
I'll take your time.
Okay. Thank you for your patience. Just needed to figure a couple of things out. Right. So we've talked about equity. We've talked about the types of share. We've talked about the number of boards, the number of members on the board.
Yep.
Maybe we could move on and discuss the dividends that we would expect from these shares to be given.
Sure.
All right. So the typical, again, industry standard for these kinds of deals would be dividends roughly around 8% of per share.
For a growth company?
For a growth company, exactly.
How would that work?
This is the information that I have. This is how it's typically done.
But then, as I understand it, a growth, basically when you have an earning, it's either growth or dividend.
Let me just explain this
Yeah.
a little bit better to you, because I feel that I'm catching you off guard on this, and I don't want this to happen.
No, sure.
So how this works is at the end, and correct me if I'm wrong, the dividends accrue on a yearly basis based on the amount of the investment. So in our case, it's 100 million.
Yeah.
The dividends are not paid up on a per annum basis. They're accrued, and at the end of our position in your company, so when there's a liquidity event, those 8% are after the liquidity event happens, these 8% are distributed in terms in stock, in kind, to the investor. So this is just an added, an increased position in the deal, and typically this is what is done, and this is information that I have. And our previous deals were 8%.
I think at this point, 8% would be really hard with the kind of valuation that we're looking at, because now I wouldn't have anything out of the company.
Why not?
Like if you invest 100 of 150, you have like 67% of my company, and then have an accrued yearly 8% of dividend of the basically the growth, right? Then I'm kind of left with nothing after 3 years, even if I do really well.
You're valuing your company at 350 million.
I agree, but I'm saying you're valuing it at 150 post, right?
Yes.
So if you invest 100
Mm-hmm.
and 150, that means that you're going above 60% from day one.
Explain to me the 60%. I'm lost here.
If you invest $100
Yeah.
million in $150 million firm,
Mm-hmm.
right? What's your equity?
67%.
Yeah.
Yes. And
And then there are dividends that are coming in as well, so that when you cash that out would even increase this 67%. Am I understanding correctly?
no, I don't think so.
Okay.
I don't think so. It's when the 8% accrued dividends on those shares
Yeah.
are how it works is it's essentially conditional to a liquidity event. And the liquidity event happened given a high growth to your company. So if there is a liquidity event, which is likely if we back you up, you will be recovering a lot more. Your company will be worth a lot more than the 150 million. It'll be worth, I don't know, typically these companies, and we're looking for 100 times the value after the next liquidity event, and we would be getting 8% growth on our $100 million investments. It's not 8% on the final valuation. It's on our initial investment. So let's say in 4 years, you have the liquidity events, for let's say 5 years to make a nice number. So we get 8% every year on our $100 million investment. Your firm is worth 100 times if that happens, and if the growth happens. Whoops, let me just.
Sure.